Okay. Any questions, ideas, comments? Was it helpful?
I have two questions, Ramin.
Yes, Jean-Claude.
It was very helpful that I liked the new strategy you showed. It'd be great to have a class on it.
Okay.
Yeah.
We'll do that. I mean, the good thing is, again, you have a lot of foundations, so I think it won't be a long class, but I will use some examples, definitely. Okay, I'm glad.
First question is, you have a slide where you're showing the ESD 5-minute
Yes.
before the trend. So just going back to it, there's a gap at the beginning of the week, so we'll have to watch out for that being filled, I guess, because it hasn't been closed yet. So if we see the S&P trading towards that gap, then there's a likelihood that it's going to try to close it, right?
Yeah, this is the one I'm talking about. Generally, I mean, our gap play, as you know, depending on the day of the week, and it's usually like 70 to 80%. But these markets, for whatever reason it is, they have memories, and I don't know what stocks don't do that as much. But the markets, the market makers, the algos, I have no idea. They usually do not like to leave a gap open. They have this tendency. So last week when I was observing, I noticed, well, we had a gap here and it never got filled that previous week. So I make a notification on that. And it doesn't mean it's going to close immediately, but I just leave it as a guidance, as one of my pivot points. And as you could see on Monday, it kind of did its job, and it did. It happened. Now, this week, for instance, on the other hand, what we have is the gap from last Monday now. So I will make a notification on this, and just in case, I'd say, this week, let's see if the markets would like to go and take care of that business, or or we can also look at Friday's gap that never got filled, but it's a very tiny one. So these are the little things. That doesn't mean 100%, Jean-Claude. As I said, I always work on 70 to 80%. If I do that, and then when option selling, for instance, every time we talk about, I look at delta of 30 or 20. That means I like to have 70, 80% on my side. I know exactly where I stand, and this one is 80%. Well, the odds are better than 50-50. So why don't I make a notification? So for next week, I will put these zones on my, I draw the lines, but if you want to write them down, just pin them somewhere. Just be aware of that. That was the whole idea. Just be aware, especially again, Monday, it happened so quickly. And you can see it was really a big, it was attraction for it. So. Okay.
Yeah. And the other one, you had a graph on the real returns of various commodities in inflationary periods.
Yes.
So is that from 1920 to 2020? But these were only in times when inflation was high, or is it just in general?
No. This is just. Yeah. So that was done exactly. It was when the inflations were. The time of, let's say, in 1970s or early 1980s. So yes, that's why I mentioned it's the cycles that we were in. So in those cycles since 1920 to now, anytime we've had an inflationary pressure, which it looks like we might be going in, I don't know, they're telling us not to worry. These are the assets that if we start that cycle, and we've discussed it about maybe commodity cycle starting, basically these are the ones, and this like energy commodities, like for instance, when you go back to 70s, that was huge winner, for instance. So yes, so that's when they say regimes, those are the cycles that we were in. So
okay, thank you, Remy.
Thank you. So I could clarify that too. So
hey Ramin, this is Sean. Sorry,
Sean,
I was late.
No, I'm glad you're with us. Appreciate it.
So follow up the question on this chart. It looks like the real estate was not beating with the inflation, it's actually has a slightly negative comparing to the inflation, right? The real
Yes.
return is negative. Okay, that's you know, what I didn't expect. I thought many people talk about, so when inflation is high, buy the houses. That's the best way, right? And that's why now the housing market is so hot.
I think what there's a few reasons for that. It was a taste of basically there's a couple of reasons I would suggest. Number one, COVID really expedited things, but obviously the main reason is the low interest rates. And it keeps going back to, I remember in the 1980s, for instance, when I bought my first property, interest rates were like, my mortgage rate was 15%. So what I could buy, like that payment of 15%, and let's say I bought an apartment building for 200,000, I can use that same payment and buy $1 million property right now. So, and forget about the inflationary thing. So did supply and demand came into picture that people, they don't look at what is the value, they look at what is my monthly expense. And because of the monthly, a lot more people can qualify. And if that is the case, then they don't really even negotiate 900,000 or 1.1 million. You know, they look at, oh, it's going to make $200 a month difference. I can do that. So that was, I think, that the rates played a huge role. And also we had the cycle. The second part is alternative to any type of investment. So when you have low interest rates, where does your money go? Gold doesn't pay you any interest. The money will go either to stock market, which has been doing it, and it's still you have people who do not believe in the stock market. So basically, they completely believe in, you know, real assets, and basically they love real estate. So that was another one. And of course, COVID as a whole, what happened with the movement from the urban area to suburban, and also the millennials come into the picture, that also became a big factor. Granted, you know, we talk about the cost of building and, you know, lumber and other things, that played a role. But as a whole, that was, I think, one of those are the other reasons are the main reason for the movement of real estate. And you're right, what happens in the long term, yes, real estate actually, when we looked at, I think I shared it last week, from 2000 to now, it had done very well. It was better than stocks, but we really didn't have any inflationary regime at that time. We're talking about really high inflation. And at that time, it is, again, this is a study, I haven't done this, so I looked at this, so this is not my study, but it was just interesting in the high inflationary times that the value of actually what happens in this case is the net. And when we look at it again, we've had some really bad inflation. As a matter of fact, for instance, in 1970s, I recall my dad, when he bought his first property, this, you know, the real estate was really cheap. This is during Jimmy Carter's, you know, first year, and he bought the properties for nothing, and the inflation was high. So basically, that was really good time. So really, 1970s, when you go back, you look at the real estate. I don't believe there is, and it said specifically residential. We are not looking at REITs that they pay dividends and other things. So that residential, you know, they didn't keep up in 1970s. They were very attractive toward end of the inflation, actually, rather than beginning of the inflation. So does it answer your question? I don't know. I'm so old. I go back to my history, Sean. So I'm not talking as an academic here. I'm talking as like my own experience. But you're right. I mean, real estate, but real estate does go through its own cycles as well. So.
Okay, thank you.
You're welcome. Any other questions or comments? If not, then.
Ramin, I had a comment. Like
Oh, Martin, always, please.
So when you started talking, you mentioned there's this general notion that like COVID is over and things are getting back to normal. So I spoke to some of my apparel people in the week, and they all told me the apparel business is not going to be back till 2023. The whole supply chain is broken. Most of the production is in Vietnam, Malaysia, in Southern Asia, and all those factories are closing down. And from their standpoint, from their viewpoint, the supply chain, especially in the apparel business, is just going to be terrible. So I'm trying to match up this notion that people think COVID's over and it's all done, when most of the production of the stuff we consume is made in Asia, and they're having a terrible time with it.
No, I think maybe there's some misunderstanding, Martin. No, I didn't say that. As a matter of fact, I mentioned how Malaysia, for instance, right now has the highest number of variants. My notion was, although the numbers are up, what I was trying to say is I don't think you're going to see a close of the economy, even as bad as it gets. The economy will continue, and basically the businesses are going to try to continue going. As far as the supply, as I mentioned, just China just opened its port. So it's the first time, it had opened. So that was good news, but we still, as I mentioned, with the cars, their production is down because they don't have the supply. So it's going to take a while. This variant is there. It's just not as deadly as possible. But I'm talking about mainly like United States, or like you talk about Western world, like UK or in Germany. I don't think they're going to shut down the economy the way they did. I mean, people will be revolting at that time. But that doesn't mean the cases are down or done. Even this vaccination, we are not even sure. There's been some studies done, a lot of people who've been vaccinated, they still get this variant, except this variant is not as deadly. So no, that was not my notion that, no, we are good to go. No, actually, as a matter of fact, I think there's a lot of questions to be answered. And but the idea is, as far as the growth of the future, I'm looking at, basically, you could see the crude oil demand was down precisely because of that. But the people are resigning to the fact that this is the world we're living. But then I'm sure you watched the soccer game this morning. People are no mask, they're sitting right next to each other. The concerts have started in the UK, and people are going to the concerts. And so it is still a concern, because we still don't know what happens a year from now. So that was not my notion that, no, we are good and the supplies are, no, it was just, as far as the supplies go, is actually the chip companies like Micron. If you look at Micron, for instance, and look at Taiwan Semiconductor, their stock prices have been down, and they still think that they will not get back to they were mid 2022. So that's their projection. So, and based on that, I see the production of cars have been affected. So no, we are not out of the woods, and I appreciate sharing that, about apparel, yes. And again, especially in Southeast Asia, for instance, I mentioned Malaysia, Indonesia, they are suffering. So that's going to affect us. And that's one of the reasons for the inflation numbers. I don't know how transitory it is, because still we will have that dilemma as far as the supplies go. So I don't know. Is that more clarification?
No, just clarify the point for me. Yeah, thank you.
Thank you very much. Great observation, though. Thank you. Okay. If there's no other questions, so hopefully I will come to you on Wednesday from, I don't know, either most likely from London. And in the interest of time, I might have to do it like maybe 2 o'clock, if that's agreeable. And we will do open forum, just in case, the things are just ideas. The following week I will do on, perhaps it seems like there's interest, we will do back spread ratio strategy. And then Saturday, hopefully, depending on my connection and all that, I will definitely do our market strategy next week, but coming from either Manchester or London. So, but anyway, in the meantime, I wish you all the best. Have a wonderful weekend. And I look forward seeing everyone from overseas. By the way, my COVID test just came and it was negative, so that's good news. So at least one thing, less thing to worry. So anyway, I appreciate everyone. Thank you so much for being with us, and talk to you on Wednesday.
Thank you, Ramin.
Okay, thank you, Ramin. Good luck.
Oh, thank you so much. Bye.
Yeah, have a nice trip.
Thank you so much, Sean. Appreciate it.